What is up, YouTube? This is the Working Investor. In this video, we're going to look at the 3 worst performing single stock ETFs by Yieldmax, the worst performing garbage. We're also going to compare all of the Yieldmax's Bitcoin related ETFs, and we'll compare the performance year to date to the price of Bitcoin and compare it to NEOS, BTCI. And we're going to compare their YMAG to YMAX to Curve's KQQQ to the S&P and the Russell. Let's get into the video. So by far, the winner of the worst performing stock of Yieldmax, which everybody's asking Jay to kick this one to the ground, is MRNY. MRNY is down 82%, almost 83% year over year. Since inception of October 24th, 2023, it's down 83%. So this has really been a losing endeavor. Now, the worst part is, I'm going to show you the worst stocks right now. So here I'm comparing and seeking alpha total return of the 3 worst performing stocks of Yieldmax, and we're going to compare them to their underlier and see how each one of these Yieldmax funds not only are the worst performing stocks in itself because of the underlier, but they've all performed worse than the underlier. So, and it's kind of upsetting because cover call ETFs, theoretically, you should be outperforming the underlier when the market is down, because when the market is down, you should go down with the underlier, but the difference is you should be generating income along the way. But the problem is they have synthetics. They don't actually hold the underlyings, and when the synthetics get breached or challenged, it causes another issue, and they have problems because cover call in itself can have issues with whipsaw, and if they write the calls really close to the money, you can have whipsaw. So there's problems with whipsaw on the upside, and there could be problems with synthetic. That's why holding the underlier, arguably a lot of investors would say, is a lot lower risk parameter. Again, I'm not a financial advisor. None of this is financial, tax, legal, or any kind of advice. Please see all my disclaimers and take your own risk. So look at MRNY, and I'm looking year over year on the 1-year chart, and MRNY total return. Now this is putting in, price plus all the dividends putting back in. So it's not down 80 something percent. It's down less. It's down 69.31%, which is horrible. Compared to the underlying of MRNY and total return, they don't give a dividend, but they're down 66.54%. You could see that MRNY, having the underlier of MRNY yourself, you would have done better than even with total return of MRNY. And then if you look at AIYY, they're down year over year 36.55%. If you look at the underlier of AIYY, you could C3AI, they're only down 25.74. So 36% in change versus 25% negative in change. So you could see that you would have done better by 11% approximately having the underlier versus having this cover call ETF that generates income, and the income itself does not compensate for the delta change versus the underlier. If you look at AMDY from Yieldmax, year over year, negative 33.77%. AMD, so actually this is an exception, so I take that back. AMD actually is down 46%. So this is the only one that I found from the 3 worst ones that I found that actually Yieldmax did a little better. This is what I'm talking about. This is what I would expect from a cover call ETF, that even if the underlier is down 46%, on a total return basis, because you're collecting dividends, you should be down less. That's what I would like, 33%. Unfortunately, with MRNY, it was not the case. They did a horrible job. And with AIYY also, they did a horrible job. This is, because with cover call ETFs, you'd expect something like this, that the cover call ETF on a down market should outperform the underlier, because you're down with the underlier, but you also have income. So that's what I would expect, not these 2 things. Unfortunately, all these things are in YMAX. So, YMAX has a mixed bag. It has a lot of trash in there and it has a lot of gold. Some people say and argue that MRNY is a good company because it can only go up from here. If you look at the last week, MRNY's down 5.77%. The last month it's down 8.77%. Year to date it's down 35%. So it's been When it was trading around $5, people thought that all the, it's been so beaten down. There's only you can only go up from here, but you could see that it could still continue going down. Here I'm going to look at the, now of course, here we're going to compare a lot of the Bitcoin correlated assets from Yieldmax, and we're also going to compare NEOS, their product BTCI. So this is year to date. The reason I'm doing year to date is because the Bitcoin has been trending down the past, in this past, recently in the past year, and also BTC, some of these companies are newer, so I kind of want to give them an even playing field. So year to date from January 1st, 2025, Bitcoin is down 10.7%. So let's just put this in consideration. So Bitcoin is the corresponding asset that a lot of these Bitcoin, companies are based off. So if they're down more than 10.7%, I would say it's doing worse than, Bitcoin. But if it's down less than 10.7%, then you've done better with this fund than holding Bitcoin itself. So in total return. So if you look at MSTY is down 0.61% year to date. Not year to date year to date, not year over year. So since January, MSTY did a little bit better than, but even though MSTY's been down tremendously in price, it has been beaten down, and I mentioned in other videos, about almost 50% in price in the past few months. Because of the dividends, whatever reason, total return is, negative 0.61. CONY did horrible year to date, negative 22. So two times, having CONY, you've done twice as bad in total return than Bitcoin year to date, according to Seeking Alpha. And then MARO is one of their newer products, down 23%. So you've done even worse with MARO year to date, having that versus having Bitcoin itself, versus having a Bitcoin mining company that does cover call on the company. YBIT, a little better than a lot of them, negative 7.93%. Negative 7.93. So a little bit better than Bitcoin, a little bit better. So it's almost like more beta than Bitcoin. And then BTCI, negative 7.46 versus MARO 7.93. So BTCI did pretty well, relative to the price of Bitcoin. And then LFGY, negative, this is one of the newer funds, negative 18.59%. So they're pretty much, one of the worst performing. I was surprised. I was having better hopes for LFGY because it's more of a diversified basket. They have more strategies they can do, but that doesn't seem to help. The simple BTCI, which they own 25% of HODL, HODL, which owns Bitcoin, and they do cover call, which derives income. That's what I expect to see. Yes, they have the downward momentum of Bitcoin because they hold Bitcoin, but they also write cover calls, so it kind of blunts it. And of course, MSTY's been beaten up, but the dividends are pretty powerful, so they could kind of do a decent job keeping up. But a lot of people got decimated with MSTY as well. But just wanted to bring these out here. Let's look at the next matchup over here. So here we spoke a little bit about YMAX. So we'll compare YMAX to YMAG to Curve's KQQQ. Some people say to compare YMAX to the SPY, or YMAG to the SPY or the Qs, or some people say look at YMAX compared to IWM. So we'll compare it to both. So we're going to go year over year because a lot of these funds have been around for over a year. So YMAX year over year is 5.21%. Let's just look at the reference. The SPY year over year is up 10.7%. Okay, so if you do better than 10.7%, you've beaten the S&P 500. You've done in total returns. IWM, the Russell's up 1.61% year over year in total return. So anything, and then so if you're above 1.61%, you've beaten the Russell. If you're above 10.7%, you've beaten the S&P. So YMAX did somewhere between the Russell and the S&P performance. YMAG actually beat the S&P 500 in total return year over year. It's just 7 funds from the Magnificent 7 in Yieldmax, so I was pretty impressed with that. And then KQQQ, from Curve, they pooped. They did the worst from all three of these basket of funds. They actually have a negative year-over-year performance of 0.17%. So they're the worst performing from all of them, according to Seeking Alpha. What are your thoughts about kind of comparing, contrasting different funds? I'm always keeping an eye out to see which funds are performing better in different market conditions. I'm actually glad that the market's down. No, I mean, not really glad. Who's happy if the market's down? But it's good because it kind of brings to light certain funds. How are they performing? How do they perform in an up market? And you also want to know how funds perform in a down market, and that gives you a balanced picture to see what kind of investment profile you're getting into when you see both sides of the market and how they handle it. Anyways, this is the Working Investor Overnight. I hope you guys have a wonderful weekend.